Welcome back, everyone. Today, I want to continue our conversation about trading psychology and something that I believe is one of the biggest shortcuts to becoming a better trader. If you have watched my previous videos, you will know that psychology is a topic I will continue discussing a lot in this channel. As we move forward, we will dive deeper into discipline, emotional control, decision making, confidence, and the mental side of trading. And if there is any topic you would like me to cover, leave a comment below. I'll read the comments, and if enough people interested, I will make a dedicated video about it. Now let's talk about correlation and focus. One of the biggest mistakes traders make is trying to learn everything at once. They watch Forex, crypto, stocks, indices, commodities, and every chart they can find out there. The problem is that financial market generates an enormous amount of information every single day. When you are new, the information overload can become overwhelming and lead to confusion, hesitation, and poor decision making. Instead, I strongly recommend focusing on one market or at most two. Learn what drives those markets, learn their correlations, learn how they react to economic data, learn how they behave during different market conditions. Personally, I mainly focus on gold and Euro USD, Euro dollar. Why? Because a specialization creates clarity. The more time you spend studying a small number of markets, the more patterns you will recognize and the deeper your understanding becomes. Let's start with gold. Gold is influenced by several major factors: interest rates, inflation expectations, the strength of US dollar, central bank policy, and geopolitical events. One important thing every trader should understand is that gold is considered a non-yielding asset. Unlike cash or government bonds, gold doesn't pay interest. Because of that, gold often performs well when interest rates are falling or when traders expect future rate cuts from Federal Reserve. When rates fall, the opportunity cost of holding gold decreases, making it more attractive to investors. On the other hand, when interest rates rise aggressively, investors may move capital into higher yielding assets as bonds, treasury securities, or cash instruments. However, it's important to understand that interest rates are only one piece of the puzzle. During periods of geopolitical uncertainty, wars, financial instability, or economic stress, gold can still rise because investors often view it as a safe haven asset. So now let's talk about Euro dollar or Euro USD. Euro USD is the most traded currency pair in the world. It accounts for approximately 22% to 24% of all global foreign exchange transactions, making it the most liquid currency pair available to traders. The reason is simple. The euro and the US dollar are the two important currencies in the global financial system. The US dollar is involved in roughly 88% of all Forex transactions worldwide. The euro is involved in approximately 31% global Forex transactions. Together, they form the most actively traded currency pair on the planet. When you trade Euro USD, you are essentially comparing the strength of the euro against the strength of the US dollar. If the dollar becomes stronger relative to euro, Euro USD will often move lower. If the euro becomes stronger relative to dollar, Euro USD will often move higher. This is one of the reasons I like focusing on Euro USD. Instead of monitoring dozens of economies around the world, I can primarily focus on economic data coming from the United States and Eurozone. For example, inflation data, CPI releases, employment reports, interest rates, inflation expectation, the strength of the US dollar, central bank policy, and geopolitical events. Central bank decisions, consumer spending, business activities data, and other major economic releases. If US economic data comes in stronger than expected, traders may expect tighter monetary policy from the Federal Reserve, which can strengthen the dollar. If economic data from Euro improves while US data weakens, the Euro may strengthen against the dollar. Once you understand this core relationship, price action starts making much more sense. You're no longer looking at random candles moving on a screen. You're understanding the story behind the movement, and that's where real confidence starts to develop. Another piece of advice I would give every beginner's trader is this: spend time watching the charts. Not because you are trying to find a trade every 5 minutes, simply observe. Watch how price reacts around key level. Watch how markets behave before or after major economic releases. Watch how volatility expands and contracts. Watch how trends develop. Train your eyes to recognize market behavior. When I first started trading, I spent countless hours simply watching charts, sometimes 10 or 12 hours a day, not trading. Not clicking buy or sell, just observing. You have to do this. Trust me, you will get there. Just observe the charts, see how the market moves, see the reaction, look at whole and half numbers. We will dive into that later. So even today, I still spend time studying pure price action. No indicators, no moving averages, no complicated system, just price. Just look how the market moves around the whole numbers. Because screen time builds pattern recognition, and pattern recognition builds experience. The more you observe, the more familiar market behavior becomes. And finally, make sure you know where to get reliable economic data. One of the websites I personally use is Forex Factory. It's a great resource for tracking economic events, inflation releases, employment reports, central bank announcements, and other market moving news. Understanding when important economic data is scheduled can help you prepare and understand why markets are moving the way they are. And finally, if there is one message I want you to take away from today's video, is this: don't try to trade everything. Don't try to learn every market at once. Choose one market, maybe two, learn their correlations, learn what drives them, watch them every day, study them consistently, because depth of knowledge will always beat general of knowledge. The traders who succeed are rarely the ones watching 50 different charts. They are the ones who understand a few markets exceptionally well. Thank you for watching. If you enjoyed the video, leave the comment below and let me know what topic you would like me to cover next. And if you want more content on trading psychology, macroeconomics, gold, euro, USD, and price action, don't forget to subscribe, and I'll see you in the next video. Bye for now.